here's a question for every investor to think about. There's a risk in investing in Bitcoin and all crypto. There's also a risk of not investing in it, because if it's true that it becomes the 12th sector of the S&P in the next decade, some of the value in financial services stocks like banks, like money center banks, are going to transfer to these new technologies, and you simply don't know when that's going to happen. So my thesis is you should have some crypto in your portfolio because you don't know when that's going to occur. And if you completely don't have exposure to it, you may miss participating in the growth of this 12th sector of the S&P, which would be a bad outcome for performance.
How much of your portfolio is currently in crypto?
It was 20% before the correction. It's now 16.2. We monitor it every day, just like we do stocks. We're having a very hard time with our auditors and internal compliance people because it doesn't act like an equity. It doesn't act like a bond. It trades liquid 24 hours a day. So mark to market means nothing at 4:01 in the afternoon. So we're constantly monitoring that. But I'm not the only person that has this view. We are adding to that position because in the way we manage our operating company's portfolio, we can have any sector up to 20%, but no more than 5% in any one position. So given that, we have a lot of different positions, and we just put capital to work in Miston last week, that project that came out of Facebook. We're always looking for new projects because we simply don't know which ones are going to survive. But we don't need them all to survive. We just need a portion, just like venture investing. But crypto is going to cause a lot of disruption, in my view, in financial services, which is a large sector of the S&P. So if you don't invest in it, you also have the risk of missing that transition. I have a personal speculation around regulation. I talked about that earlier, that if the Stablecoin Act gets put into law, that will be a signal that all crypto will be regulated at some point. Some people feel good about regulation, others don't. But here's a fact to consider regardless of your position. Most of the sovereign wealth funds that I work for as an indexer have zero position in crypto of any kind. When you ask them if they're going to buy anything, they want the granddaddy, which is Bitcoin. They're willing to put 50 basis points to 1% into Bitcoin when their compliance departments allow them to. And that won't happen until the SEC rules on it as a commodity or a security. And the reason they can't is that these sovereign wealth funds, I don't care if you're Norway or you're UAE or you're Saudi, the majority of their money is put into the S&P. It's the only market that can absorb $1 billion in one trade without moving the market. And that goes in around 10:05 every morning when these sovereign wealths take their 250 million that they make in oil each day out of New York. These transactions, remember, oil is transacted in US dollars, and they put it into an index of the S&P, X oil, X airlines, because they own their own airlines and they have enough oil, obviously. But the reason they won't buy Bitcoin is they can't go uncompliant with the SEC. That's the #1 depository for their capital. So until the SEC makes a ruling on what Bitcoin is, they won't participate. Now here's the upside. 50 basis points in the sovereign wealth and pension world is $1 trillion of buying. So you have to be voting and cheering on regulation. You put $1 trillion into Bitcoin, that's when you might see it at $60,000 to $100,000 valuation. And those funds don't care. Once they index it, they're the automatic bid when it dips below the 50 basis points or 1% they've decided to own, and they sell into strength. So there's a really liquid market about to happen. That's very optimistic for Bitcoin, not pessimistic. I really don't understand when people say, oh, I hate regulation in a decentralized asset. You want regulation because that's where the money is. It's interesting from the macro perspective. If they lose the House and they keep the Senate, what you get is gridlock. There'll be no more spending bills for the next 2 years because there'll be nothing done in Washington in that situation, which is good for the markets, for the equity markets. Remarkably, it's indifferent for Bitcoin and crypto because what you find in all of these bills is bipartisan support, which is really something else. You look at Haggerty and Gillibrand, that's their bill, which contemplates Bitcoin as a commodity, and it deals with NFTs and lots of others. But there's 21 bills floating around the Senate and the Hill, and they're all bipartisan. So it doesn't really matter what happens. The only reason there's no crypto policy is everybody's focused on November 8th. But when they sit again in the back end of the year and they come back from holiday, they're still supporting crypto. Both parties like the idea of some regulation on crypto. So it's more about the gridlock of getting no more spending bills that the market may like, because most of market participants have seen enough spending. It's just we did the 6 trillion, and then we did the Anti-Inflation Act, which was very inflationary, and then we gave the students back all their debt, which is nuts. And so everybody's sick of the spending. I think that's the opportunity for equities. Doesn't really change the outcome of Bitcoin. That will one day be regulated. I'm very involved in the fixed income market, single B, double B, triple B, investment grade and above, right to treasuries. I'm a balance sheet guy. I've been a bond trader my whole professional life. There's no liquidity now in commercial real estate loans. The banks have completely stopped lending. And that's very unusual because they're trying to figure out where the cap rates are. And very simple. Most people assumed in the US economy, and it's the same in Europe and in Asia, that 15% of office workers would not return to the office space. AAA office tower in Boston is a good example. It was trading at a 4.6 cap. And when cap rates go up, it means things are less valuable. Today, what they found out, let's take law firms, 55% are not returning. So they've grown used to living with their families in better locations, near better schools, or taking care of elderly patients and parents. And so you've got a real situation where AAA office and warehouse and commercial and shopping malls and all of that are being revalued lower, up to 30% lower. Take Bed Bath & Beyond, for example. This how this directly affects the debt markets. They closed 200 stores in really prime locations in American suburbs. Somebody has to spend a fortune to convert them back into climate-controlled pick and pack storage facilities so they can lease them back to Amazon and other Shopify and Facebook that want to use them for delivery same day to the clients in those dense areas. But that requires capital. So real estate, which is where so much capital is lent, is going through real volatility. So the true cap rates are not known yet. If there's nothing to clear the market, maybe cap rates are 11%, not 6%, and nobody knows yet. So there's something going on there that is unhealthy. And that is a space that you can really monitor, and I do daily. So that's one of the reasons banks are trading at 52-week lows, even though rates are going up and their spreads should be going up. But they're not lending, they're not profiting off that anymore. And that's a very illiquid market. There's no liquidity whatsoever.
Wow.